Greetings, my name is Kevin Matthews, and I am the tax professor. I want to welcome you back to the Tax Academy. Class is always in session because the learning never stops. And essentially, we're going to talk about today contributing property to your partnership. Okay, and so one of the things that when we're talking about this is a question we get from time to time. Usually when people get together, so say for example, and I'm gonna use an accounting industry because it's actually much easier. Partnerships in accounting were very common in the day. Now, oftentimes they're usually formed as S corps, corporations, or sometimes actually there's still partnerships that are out there. I mean, it's not. It's less likely to happen than it would in the past, but it's still entirely possible. And not to suggest. So I'm going to use an accounting firm. So myself, a very good friend of mine who also does accounting says, hey, we want to get together. We're going to form a partnership. Generally, what's going to happen is that he's bringing his expertise, I'm bringing my expertise, and maybe they're going to ask for cash, and we bring in cash. Something else that could end up happening is I'm going to bring in my own computer, he's going to bring in his own computer, and we're going to get to work using that. From that moment forward, now we're going to go out and we're going to buy additional materials. Okay, say for example, we need a copier, we need paper, we need paper clips, we need all that sort of stuff. A lot of that's going to be expense, some of it's not going to be expense. Maybe we need a car because neither of us wants to use our own cars when we're doing this, and so we're going to get maybe a little Honda Civic. I mean, I don't know if I could fit in a Honda Civic. I'm a 6'4" individual and weigh 270 pounds. Probably not going to work well in a Honda Civic, but say we did a Honda Civic, not to knock down Hondas. I mean, Hondas are really good cars. Not as good as a Toyota that I own, but hey, there's no, that's another subject. But the fact is that we go ahead and we buy these things. That's a pretty easy to understand that belongs to the partnership, and there's generally not going to be too many quandaries or issues with any of those. Now, say for example, I have an old car sitting out in front of my house. I used to be I used to hang around rednecks a lot. I mean, I won't call myself a redneck because I actually didn't work in the fields that much, but it's not like I've got the car, the car on the blocks, okay, as was common in Texas. I mean, I remember growing up and seeing pickup trucks on cement blocks because the guy's been working on it for 5 years or whatever. But say I've got a car out here, and the car my friend comes to me and he said, well, I'll just call him John. We'll just keep it John to make it easy. And John comes to me and says, Kevin, you got that car, you're not really doing anything with it. Can we bring it into the business so that we can use it as a business car? And I'm like, yeah, sure, let's go ahead and do that. So I'm going to contribute the car. All right. What's going to happen is that I probably paid some money for that car. We'll say it's like a Honda, we'll say it's a Toyota Camry, and I paid around $20,000 for it. Okay. I'm going to contribute that car after it's 5 years old. So chances are the car is going to be worth less than what I originally paid for it. I mean, that's just the way cars are. They depreciate rapidly. Okay, so what's going to end up happening is there's, my contribution to the partnership, what's going to end up happening is that I'm going to, basically, I'm going to, it's, basis given is basis received. Okay, and that's what we tend to say in the tax world. Basis given is basis received. I bought it for $20,000, say it's worth $6,000. I get to contribute that, and my basis is going to increase in the partnership by $20,000 because I have effectively given a $20,000 historical cost asset to the partnership. Okay, that's going to increase my basis, going to allow me to take more deductions as a result of which, and all is well and good. Now, what ends up happening if I contribute something that is not depreciated in terms of value? Say, for example, I have a piece of land that I bought for $100,000. Now there's more people that are moving around in the area. Now that $100,000 land's worth $500,000. Now John comes to me and says, Kevin, why don't you contribute the land so that we can build the building that our business is going to be formed in? And I'm going, yeah, I guess I could do that. How do we want to do that? And it's like, okay, well, we'll contribute it. So we're going to go ahead and we contribute the land. And again, basis given, basis received. I receive $100,000. for the land. Now, some of you might say, wait a minute, you're contributing something that's worth $500,000. Why would you do that and only get $100,000 in basis on it? And stick with me here. There might be some additional things that are positive with that. But I go ahead and I make the contribution. I get my $100,000 in basis. Say, for example, about a year later, and temporarily while we're waiting to get the building built, John and I, we're not going to just sit around and wait for things. We're going to go set up in a temporary office, and we're going to go get things done. I've contributed the land to the partnership. And a year later, John and I come to the conclusion that location is not going to work for us. So there's two things that could end up happening here. One, they could just give me the land back. Okay, that's entirely possible. The other thing that could end up happening is John says, hey, why don't we just go ahead and sell the land, and we can take the extra cash that we have in the partnership, and we'll go ahead and we'll get our own location in a different place. Okay, that is entirely possible. However, I have contributed property that what we have built-in gains, BIG, built-in gains. And what ends up happening is that I have to attribute those gains on that property back to me first. Okay, so even though John and I may be in a 50-50 partnership arrangement, the gains on that property are going to be attributed to me as far as how much of an appreciation was done at the time of contribution. And I said I bought it for $100,000. It was sold, it was worth $500,000. So that first $400,000 of gain comes right to me. If there's been further appreciation after that, then those gains can be split 50-50. Okay, so there's a lot to be thought about here when you're talking about contributions of property that are going to be that have higher values. Another topic that we'll talk about real quick, say for example, I contribute the land, bought it for $100,000. We'll say now it's worth $200,000 because maybe it hasn't appreciated that much. But I have $60,000 of debt on it. What happens? Well, the partnership's going to relieve the debt. Okay, so the partnership's going to be responsible for the debt. So I have effectively received $60,000 of consideration in waiving of this debt. Okay. So what ends up happening is I'll go ahead and basically so the basis that I'm giving is that $100,000 minus the $60,000 in debt. So I'm only going to get $40,000 of basis as a result of that transaction. However, as Billy Mays would say, but wait, there's more. Okay, so now the partnership assumes there's a liability. Guess what happens now? I'm a partner in a partnership that's got recourse liability or mortgage or non-recourse, mortgage liability. I'm entitled to have debt basis allocated to me at at a rate of 50%. So I'm going to lose some of that basis, but then I'm going to gain some of it back. And so what ends up happening is there is a portion that, it's a calculation that has to be done. We have to kind of take a look at it. Again, if you're going to make contributions of any kind of significant amounts of property, you probably want to talk to a CPA about it. You want to talk to, the person that actually understands this stuff and can get you around it and can navigate the waters for you. And obviously, I do a lot of work in partnerships, so this is an area that I do talk about. But if you don't feel comfortable with me, or maybe there's a location issue, feel free to seek out an EA, CPA, or tax attorney. You want to make sure that you get a person with one of those designations, because those are the people who have committed themselves to really understanding these rules as much as possible. Again, my name is Kevin Matthews. I am the tax professor. I want to welcome you back to the Tax Academy. Hopefully you'll come in future episodes. Basic class is always in session because the learning never stops. If you want to reach out to me and ask a question on this, you can put it into the comment box below. If you want to reach out to me for more one-on-one conversation, you can reach out to my website at www.betasolutionscpa.com. Again, that's www.betasolutionscpa.com. I'll be happy to talk to you about your specific issue and kind of go from there. Thank you very much.